Number one mistake investors over the age of 55 making. Let's talk about core capital needs and how they change over time. Now, imagine somebody on their last day of life. What do they need? Just a $8.99, $10 beer. You might think that's heartless. At the end of the day, you can't take it with you. Let's take a more practical example. Family of four living in California, their core capital needs are about $4 to $5 million. Take a withdrawal rate of 5 to 10%. That's basically their monthly burn rate. So, two extreme cases. Basically, the takeaway is your financial needs evolve over your life stages. To give you a more practical point, an older couple in their 50s and 60s with grown up financially responsible kids, they only need about 1 to 2 million of net worth to comfortably get $10 to $15,000 of passive cash flow per month. Cheers to understanding your core capital needs.
Think of this graph as your wealth in terms of your legacy capital increases and your core capital needs go down. So the way I explain this is this B core capital. Think of this as your passive cash flow number. When you've got a young family of four, you probably need to shoot for something like a 4 or 5 mil net worth. The older you get, and this is an extreme, sad reality, that if you knew you're only going to live another day or another month, you may only need $10 for that one last beer, right? So that's an extreme example of how this number works its way down. Of course, we all are in the middle of this paradigm. And for that, just to add another data point in the middle there, an older couple where the kids are long gone, maybe you guys are single, but certainly not really any financial liabilities from kids who are deadbeats that you got to provide for. That magic number goes down to about $1 to $3 million net worth. And of course, everybody's got different burn rates, and that's what this core capital is. It's basically your monthly passive cash flow number. But yeah, it goes down. So that's where this premise of this line is generally going down over time. So keeping with the idea of like this darker color, this is your lifestyle spend. If you feel free to take a screenshot if you like this and ponder this in the future, or some of you guys have your spreadsheets of your month budgets. Think about it in terms of lifestyle spend versus this lighter gray color, which is your legacy capital. This is your money that you try to have at the end of your life in your golden years for giving to your kids, grandchildren, discretionary spending, luxury or high-end fine wines or new ventures or charity at that point. The idea again is as you get closer to your dying age, which none of us know when that is, your core capital needs go down and you tend to have more capital for the legacy part, whether you want it or not. Now, the biggest mistake, most people are trying to go for 99% confidence that they will have enough core capital by the end. And you need to understand that there is a trade-off of you have limited time to achieve this. Essentially, the real goal, if you read the book, Die with Zero, the idea is to maximize experience by spending money to optimize your finances in that time. But this is where we've all witnessed in 2021 to 2023 is this great correction. On this top side, as you see the interest rates, 40-year high in interest rates, quickest time in history. This has happened many times before. Traditionally, when interest rates are high or all-time highs, that's when you load up on assets. And when that thing comes down, the prices tend to go back up. In commercial real estate, right here, the peak to where we are now is now a bigger correction than it was in 2008, the Great Recession. That said, the Great Recession was a correction within the residential world, where this one was more of a correction in commercial real estate. You can see where some of the projections are and just another way of seeing how far things have come. I think it's time to ask ourselves, when are we going to make our entry into the market? And I pose the question, is it 2009 and 2011 again? Most of us were around during that time and we had some skin in the game. We had exposure and we saw some type of correction in 2008, 2009. What I would say is think back on where you were in 2009, 2010, and 2012. What were you doing? Did you really have skin in the game? How were you playing that big shock and awe correction of 2008? Because it looks like the same thing. A couple of things I'll point to as evidence, the ITR report. This is as of May 2024. They took a look at a lot of these indexes, and you're lighting up a lot of green there in 2025 across the board. A lot of business owners, big companies will use ITR economics, data-driven information to predict, should they hire more people? Should they buy more inventory to produce more next quarter or next year? Put in a lot more simpler form, they have this Trends 10 report where they put the major sectors on the sine curve and they attempt to plot it there. Now, this past month, I put it in the Discord channel. There was quite a bit of change that happened. Previously, housing and financial were just a little tick lower here. From their point of view, it's already gone through the hard landing. And why did financial and housing lead the charge into the trough? Financial and housing is directly impacted by interest rates. And when this happens again in 28, 2032, it'll probably happen again. We will all know what gets impacted most. I think everybody should have that etched in their minds. The thing that happened this past month is previously all these other 7, 8 components were stacked right here. Nobody knew if it was going to go down the hard landing track or the soft landing track. But it now appears that ITR is willing to put themselves out there, which is very rare for economists, that now you're starting to see some of these sectors go down either the hard landing path or they put retail in the soft landing path here. I think a lot of this represents what's in the stock market, which has been pretty high, although I'm not going to make any predictions there because I don't have my personal funds in it, but I food for thought right there. What we do know is housing, financial has been beat up and it's on the trend up. Commercial real estate has been beat up about 30%, and then ITR economics, their little trends. I think safe to say that there's 2 or 3 pretty decent indicators that there is the light at the end of the tunnel, or perhaps we've already come up and this is the bounce back. I pose the question again. It feels like 2009 to 2011. Again, ask yourself what you were doing in this time and are you ready to catch the wave again? So I took this one step further and I was like, all right, if you're still thinking about how I explained this core capital needs before, as I said, it's a declining type of goal right here. The longer you wait, if you wait 40, 50 years, you may only need $10 and you get to the goal at some point, right? So this goal is ever decreasing. The longer you wait, the more you're going to have to tread water in the meantime, and that you eventually get to your goal. But I think a lot of us, what we see is we want to find some type of path to this line quicker rather than later. A lot of this is a little esoteric and can be construed in different ways, but I just posed out there that, all right, say a guy takes a more aggressive approach, you could probably set yourself up pretty well that you get a nice bounce off the bottom. Some of these deals or investments double in half of the amount of time you originally thought, and you're maybe super amazing place 5 years from now. I'm not saying I would recommend that path, right? But I'm just posing it and putting it on this realm of possibilities chart here. What most people will do, the status quo people will do, and maybe some people within our ecosystem, they'll opt for the status quo. And if most people we're assuming are in their 40s right here, it's going to probably take you to your 60s or late 50s to get to where you want to be with that. I think all of us would agree that we don't really want that to happen. It's just too damn long. So we're somewhere in between this bookend of aggressive and between here and here. I would probably argue that I think you want to be a little bit better than what I've put here as confirmed bottom. So what does confirm the bottom mean? People have this idea that we want to see interest rates start to come down a full percentage point, and we want to see real estate prices come back 10 to 20%, or at least half of where it was or where it retracted. I'm like, all right, that's very reasonable. You want to play it conservative, but we all know that once you've confirmed the bottom, you've already missed out on most of the good hunting by that time. And I would argue that if you did that approach, getting to where you want to be will probably take you 15 years. So everybody's on a different time horizon. They have different amounts of dry powder, but I just wanted to pose this thought process that maybe somewhere is between the aggressive and confirming bottom. And this is where I've drawn out a couple of scenarios that one might choose, which would be Maybe you do half now, half at the confirmed at the bottom, or maybe a fourth now, maybe three-fourths confirmed at the bottom. Now, I will note that both of these are impossible to hit because you have to dollar cost average. So say you had $1 million of deployable funds. Some of you guys have more than that. $1 million of deployable funds, say you invested $100,000 into a project. Unless you're doing like $100,000 investment every 2 weeks, you're not going to really be able to deploy in 12 months, if you're seeing what I'm saying. Dollar cost averaging is going to naturally happen over time anyway. So if you were to say, I'm going to deploy pretty aggressively, one deal per quarter, $100,000, it's still going to take you 2 to 3 years to get deployed. I feel pretty confident that you're probably going to start to deploy a good portion of it, maybe even half of that, past the confirmed bottom point. Again, something to just keep in mind, something to mind map out. If you're like me, who's neurotic about finances, it's the idea of, man, don't you just want us to have the voices stop in your head to stop being frugal and saving and investing? Wouldn't you just like to, bam, get up to this line and then go into a bunch of T-bills and chill out at that point? If that provides some mental relief to you, like it does me, that may be some motivation to accelerate this quicker. NBA Finals is again tonight. The Celtics are going to try and knock out the Mavericks. If the Celtics get up 11 points with 6 minutes left in the fourth quarter, they're probably going to go for the knockout punch at some point and try and drain a half-court three or something like that. And if they make it, they're there. They can start to crack the champagne open and enjoy themselves. Were you aware of, hey, I got to go grab my nuts before the winter comes in 2012 and 13, before the opportunity goes away? Or maybe you were already invested in like the standard investments and you are already deployed, so there's really nothing to do. Most people, what I see now and what I think happened in 2008 is they got depressed. They stopped checking their Vanguard for a couple of years and they stuck their head in the sand. And they also didn't rebalance their portfolio. But that's the status quo. And unfortunately, part of investing is to always go against your gut in a way. Whenever things are fearful, that's when you need to be greedy and vice versa. Market cycles typically last 7 to 9 years. I think that logic might be out the window because they just create phony money. But if you still believe that, for most of us here in our 40s and 50s, you're only going to get one more shot at this bounce off the bottom. For a lot of people here, maybe half of you guys, this is the only one in your lifetime. But again, I would just take some quiet time and think where you were in 2009 to 2012. What did you do? What was holding you back? I think we're all victim to just following the status quo. This might be premature, but I think that there's going to come a time, maybe now, maybe it was 6 months ago, or maybe it's a year from now. I don't know. Nobody will ever know. But I think it'll be very clear that maybe in 5 years, you're going to look back at today and be like, geez, I just sat on my ass doing nothing. Now, some people, they got rocked pretty hard in this last one, and they may not have the deployable equity. And unfortunately, it is what it is. But there are a lot of people that they didn't really bring out the troops, and they still have majority of their deployable assets ready to go at this point. Some people would die for that opportunity. But with that,
Cheers to understanding your core capital needs. And check out thewealthelevator.com/podcasts and my new book, The Wealth Elevator.
going through this whole transition myself, it was really hard to do it without meeting other purely passive accredited investors out there. So that's why we've created the network, which you guys can join